Hi, everybody. Happy Wednesday. Happy hump day. Today is Wisdom Wednesday. I'm Miranda with Keller Williams Success Realty. Thank you for joining me today. We are interviewing Eric Schroeder of Mortgage Capital Group here in Crystal Lake. He is a mortgage broker. He has been doing mortgages for 20 years and has owned his own brokerage for 15 years. He is my go-to mortgage guy, mostly because I think he really knows what he's talking about. He helps my clients get the product that they need with a mortgage, and he helps them know exactly what their payment is going to be every month so that they know how much they want to spend on a new home. So welcome, Eric. Thank you for taking time to speak with us today.
Miranda, thanks for having me.
So today we wanted to talk a little bit about the Fed funds rate. So the news is today at 2 o'clock that we are speculating that the Feds will hike the rate 75 basis points. Tell us a little bit about what that means for mortgage rates.
So for mortgage rates, it has nothing to do with it at all. It really helps your mortgage rates, and because it helps our economy to raise the prime rate. And so as that goes up, it gets our inflation that we have in this country, which I believe is over 9% now. It gets it under control, and that's what the Fed is doing, is trying to control those things. The good news is as your followers are driving home in their car and they hear on the radio that the rates, prime rates went up 0.75%. That has nothing to do with their 30-year fixed mortgage at all. The only thing that has to do with 30-year fixed mortgage rates are the 30-year fixed mortgage-backed securities. And so that's what we're watching. And as investors and bond traders buy those, that's what's causing your interest rates to go up or down. It has nothing to do with the Fed raising rates at all.
And isn't that so funny? Because if you're only listening to the news, you seriously would think that the sky is falling. Every house is going to burn down. No one's going to buy houses. I mean, if you only listen to the news, it is all doom and gloom. And that's just not what we're seeing in reality. And I think that, the news medias want us to watch because fear sells. But the reality is, like you said, I found that so interesting when you told me that when I hear the Feds are going to hike the rate 75 basis points, you think, oh my gosh, my mortgage rates are going to go through the ceiling. No one's going to buy a house. This is going to be terrible. And that's just not what the case is. And I thought that was so interesting when you had said that it will, because they do need to get inflation under control, because inflation is out of control. When I go to the grocery store, I can't even believe how much money I'm spending on groceries. Gas, we all know, is through the roof and causing problems for people. But what you had said is that when they raise the basis points, the prime rate, it actually means that different loans are going to be more expensive.
Yeah, there's going to be your boat loans, your car loans, things like that. That's just going to be affected. And you want to keep in mind that inflation is the enemy of long-term bonds and that's what your long-term 30-year fixed mortgages are all about. Keep in mind that as you borrow and as your followers borrow their 30-year fixed mortgage, there's somebody on the other side of that glass that's investing for 30 years, and that's a bond that they're buying. And so, there's that correlation, and that is the only thing that makes a difference. Anytime you've got an inflationary period, it is the enemy of bonds. It means a bond is essentially a fixed interest rate that you're getting for 30 years. It doesn't fluctuate at all depending on market. And that's usually something a more conservative investor wants to have, or at least people want blended in their portfolio. And so as this happens, as the inflation is going up, your investment in that bond and your return is actually losing money because inflation is happening faster and more than what you're earning on that. So, you want that inflation under control. And this is good news when the Fed raises rates, because we need to get inflation down. And that's the idea.
Yeah. I have been saying that all week too. It's like, we've got to get this inflation under control. So the fact that the Feds are raising rates, this is actually a good thing, people. Don't be upset, because it means that we're going to get the cost of other goods and services to come down. So my other question for you is, so how does this affect the housing industry? How does this affect someone going to get their loan? So it's got to affect it to some extent, right?
Well, everything else, just to your point, everything else in life is becoming more expensive. I mean, you've got gasoline and all those different things. So it's just really important as the mortgage rates do creep up, and they need to. What has been keeping the mortgage rates down for many, many years now is something called quantitative easing. It's also something the government has been doing, and nobody talks about it all, where really the federal government is buying, the Fed is buying mortgage-backed securities and creating an environment where our 30-year mortgages are lower. What you're going to start to see, although it's slow and ineffective, but they're getting there, is that the Fed wants to stop buying those mortgage-backed securities and to let the market return to normal again. And as you see those rates creep up, it's important to talk to your mortgage professional so that you know what the rates are. That's fine, but to also keep control and have a budget in your household as far as what everything else costs. I was talking to you earlier that, when people have the difference between a 680 credit score and a 780 credit score is a full percent difference in 30-year fixed mortgage rates. And so there's not a lot we could do about the economy. And if you need to move as a family, you need to move. You need those bedrooms, you need to get rid of those stairs because your knees are hurting, whatever your reason is, you need to move. There isn't anything you can do about the economy. What you can do, though, is about your own personal finances to make sure that you're getting the best mortgage rate you can by having the highest credit score you can get.
Well, so a couple of things that you brought up there that I want to talk about. One of which is I was on a call this morning, Keller Williams national worldwide call actually, and they were talking about how the economy should be irrelevant to whether or not you're moving. If you need to move, you need to move. If you're getting married and you want to live with your spouse, you need to move. If you're, moving, you got a new job in another state, it's time to move. It's a good time to move. Your motivation needs to be more important than the economy. So that was one point that you brought up that I totally agree with. The second thing, because the economy is always going to be changing. Everything's always going to be changing. The other thing I wanted to bring up is a couple of different things we talked about before we started recording. One of which is, what is the difference in a point on your mortgage? So like the difference between a 5% interest rate or a 6% interest rate, how much does that actually break down to monthly in someone's payment?
A $250,000 mortgage is about $150, $156. That's the difference. That's it. And that's why I go back
about this.
I know. That's why you go back to keep track of your credit score. Make sure you're talking to your mortgage professional so that you know what payments are on homes. Because your down payment matters a lot with your interest rate. A lot of things you as a consumer can control can be controlled, and make sure that you're paying attention to that. Yeah.
Drop the mic. That is the number one point for the day. The things that affect your interest rate the most are things that are under your control. Oh my goodness. That's a great point. I mean, talk to your lender about how to increase your down payment, how to increase your credit score. That's going to make a bigger difference than what the economy is doing. That's a fabulous point.
And there's a lot of programs that are out there too, depending on where your income level is, different things that you can plug into as a consumer. Educate yourself so that you're getting the best mortgage product to go with your individual scenario as well. A mortgage is an individual fit. And it's important that you have that conversation with your mortgage professional.
So can I ask you a question? And I love to ask you this question because I know your answer, but I'm going to ask it anyway so everybody else can hear it. What do you think about those mortgage calculators that people can get online and they can just plug the numbers in?
I hate them. I hate them.
I know you do. That's why I asked.
I don't know who does them or who writes them. Your credit score affects what type of mortgage insurance rate you have. I don't know where the interest rates come from that they plug into those things. I don't know. We don't know. A lot of my notice forget homeowners insurance. So homeowners insurance, if you buy a $300,000 home, you've got a $1,200 a year homeowners insurance policy. If you plan on having an escrow account, that's $100 a month. That means every time you plug it in, if they forget to put homeowners insurance in, which I'm not saying all of them do, but they always miss something, and that's usually when I find you're missing by $100.
Yeah.
So, a mortgage is an individual fit. You've got to talk to a mortgage professional so that when you call in, we have our clients call into the office. Hi, this is Susan Jones, and we give Susan Jones her payments based on her down payment, her credit score, her mortgage insurance rate, her homeowner's insurance. We're local, so we understand taxes around here. So all those things need to be put into play that you can't get on a website that's designed in Seattle somewhere. Just can't do it.
Yeah. Totally. And then one last question. What about refinancing? Let's say somebody is like still thinking, gosh, I don't like the rate that I'm going to get. I want to get a lower rate. And what if rates come down? How do I, let's talk about refinancing a little bit. So if they buy a house now, they get a rate they don't like, rates come down. Tell us about that.
Rates come down. Everybody, I think, understands that. You can lower your interest rate. We just talked about a $250,000 mortgage. You drop 1 full percent, you'll save $156 a month. That's there. When you talk about refinancing, and what we do is we actively call all of our clients that closed on their purchases or their refinances. If the rates go down, we actively call out. But if you're tracking it yourself and you're paying attention, the key to refinancing, there's only one word you need to remember there, and it's break even. break even. How much money do you spend to refi? We all know refinances are out there, but they will, a lot of banks will charge you, and not just banks, brokerages, everybody charge you closing costs. In an ordinary situation, you're going to pay about $1,100 in closing costs, $500 for an appraisal if you need one, and your local title company $650, $700 to close. However, there are tricks to that you can do. If you can drop 1% and spend, all that money on a refi, if you take a quarter higher in rate, maybe instead of saving $156 or $150 a month, you save $120. That bank, because they know they're going to collect that quarter in interest over the next X amount of years, will actually cover those fees for you so that you're not spending that money. So there's ways to manage your mortgage rate and not spend a lot of money. And whenever we have our clients refinance, we are always focusing on how much did you spend, how much do you save per month, and when are you breaking even on what you spend? And it's just that's easy. That's when we decide to refi you.
And how quickly can someone refinance after they buy a home?
In my world, it's 6 months. The banks that we set you up with, I've got contracts with 12 different lenders that we use. They all want you to hang on to the loan for 6 months, which means I'm locking you into a new interest rate 4.5 months after you close on your purchase. Or you close on your refi. So it's not a lot of time. And it's amazing to me. I sit here on a Saturday or on a weekend and call all my refinance clients that I think could save money. If I call 10 customers, only 3 of them call me back. So I know there's a lot of concern about interest rate, but it's only when you're looking to buy a home that you're really worried about it. That's my other advice to your followers. When your mortgage guy or gal calls, answer the phone. They're saving you your $100 a month that you were worried about when you were complaining when you were buying a house. You know what I mean? So
call them back.
That's what I would say. Yeah, for sure. Opportunities are coming.
And there is some speculation that Q1 of 2023 that we will see some lower interest rates. I've read a few different things that have speculated, and again, it's all speculation, but I have read a few things that have said in Q1 of 2023 we'll see some of these mortgage rates come back down to the 4s.
All right, got that recession coming up. Barry Habib, who I follow, I know you do too, says every time we have an inflationary period, the Fed raises interest rates, and then we head into a recessionary period. Well, the one thing that's good about a recession, you may be losing your job, which I hope nobody is losing their job, but during a recession, mortgage rates tend to drop. And so that's a great environment that if you're getting into something this year, you're maybe not totally comfortable with, there might be an opportunity to clean that up first quarter, second quarter next year.
Yeah, well, let's hope people stay employed. Around here, we have pretty low unemployment rates, so let's hope that stays. Well, Eric, thank you so much for your time today. I think you have given us so much perspective, so much wisdom. We really appreciate you. I appreciate you all the time, everything that you do for my clients, all of the information that you help me understand about the economy and mortgage rates. I have learned a ton from you, not only today, but over the last few years. So thank you so much. Anybody out there, if you would like to call Eric, if you have any questions, please call him. He is at 815-455-4422, or you can email him, eric@mcglending.com. We'll make sure we put all that in the comments as well. Thanks again, Eric. Have a great rest of your day, everybody. And we'll be back next week. Thanks.
All right.
Bye.